Morning, John.
Good morning.
Yes. Good morning. I recently sold a rental house and wanted to know what some of the things we could do to minimize the tax consequences.
So the best thing is get out your old receipts for, did you put up a fence? Did you replace some windows?
Right. I know about that.
Okay.
Yeah.
So then to calculate the gain or loss, you're going to be looking at, of course, you can deduct all of the sales costs for selling the property. So you're only going to be paying on what you net. So if you have real estate commission, if you have closing costs, etc., that reduces the gain. But the one thing you're going to have to do is what increases the gain is, again, as I mentioned with an earlier caller, depreciation recapture. So your basis in the property is simply what you paid for it, plus the costs associated with purchasing, plus improvements.
Not maintenance.
Not maintenance,
See,
right.
A lot of people get that confused, I've seen.
Right.
They say, I put in new carpeting, I painted it. That's all maintenance, and that's deductible in the year that you do it.
That's right.
But it doesn't increase your cost basis.
Yeah, so the key thing is if you've deducted it as a repair, you can't turn around and deduct it later. But if it's an asset, like you put in an air conditioning unit, you typically depreciate that over 15 years. So you'll be able to recoup that, what you haven't depreciated thus far. But so specifically, you go through that exercise and you subtract the basis, which again is your cost plus the cost to purchase, plus any improvements, and then you compare that to the net sales price that you receive, and then you've got to add back in whatever depreciation that you've incurred.
If you have a large piece of property, you have a large gain. The only options that you have to defer the taxes is to do a 1031 exchange,
right, or
put in a charitable trust. You can defer the taxes and then get income for your lifetime. So those are basically the options. But there's no thing of taking. Some people kind of think, Gary, that remember the old rule about your residence. If you bought another equal or greater value, you can roll the gain into it. Well, those days are gone.
Can't do that.
And you can't do that with an investment property unless you do it as what's called a 1031 exchange. And there you need a qualified intermediary to help you with that transaction.
Now, one other thing you can do is you can sell on the installment sale.
There you go.
So you could say to a potential purchaser, give me $50,000 down or whatever equity that you would want to be comfortable in. And then you could say, pay me over a period of time. And that's useful to stretch out that capital gain over many years, especially if you're in that situation where the capital gain, if spread out, wouldn't be taxable. So sometimes, financing the property for somebody and collecting that principal over time helps save taxes.
So those are some options for you.
As far as the tax liability, whatever tax bracket you're in, that's what it would be?
Exactly. Now, it's the sale of a capital asset, but a portion of it might be taxable as ordinary for recapturing depreciations. But in general, yes.
You have capital gains treatment on it.
Okay.
Okay?
Okay. Thank you so much.
Appreciate the call.